Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steven Ehrlich, Director of Research of Digital Assets at Forbes Crypto, to discuss what liquid staking is and why those tokens are surging, as well as the future of stablecoins. Steven, it's great to see you as always. Welcome back to Trade Talks. So before we get into those nuances, what were some of the big trends in crypto markets this month?
Sure, Jill, and thanks again for having me on. So this month, it was really kind of some of the big tokens, the Bitcoins, the Ethers, sort of treading water, looking for a new direction after a very exciting start to 2023, when both tokens surged around 35 to 40% in January. As this month is rounding up, those tokens are about half a percentage point up or down so far on the month, and I think that really just kind of speaks to the sense that in this current economic climate, a lot of investors and watchers are trying to figure out what's going to happen next. There's growing fears that the Fed's going to raise rates by another 50 basis points at the next meeting in March, and just frankly, I think a sense of exhaustion with the bear market rally that I think some of us are seeing this as, and kind of what you alluded to in your question, though, there are some tokens that are surging well beyond Bitcoin and Ether, and many of them are in the liquid staking and layer 2 realms, and then some also are tokens that are piggybacking off of trends related to artificial intelligence, and just I think a little bit of excitement or I guess like fear of missing out. In particular for certain tokens like Base, which is a token that has absolutely nothing to do with this new blockchain layer that Coinbase launched, yet it surged about 750% in a day after Coinbase announced the launch of its platform last Thursday. So this is kind of a tricky time for investors where you kind of just, it's enticing to try to regain everything that was lost last year, and crypto has gotten off to such a good start so far in 2023, but you need to make sure that you look past and step past those landmines that are out there.
Right, so let's break that down a little bit more. Explain to us what liquid staking is and what layer 2 networks are.
Right, so liquid staking is sort of a novel and kind of interesting feat of financial engineering, where when people, well, let's first explain what staking is. Different blockchains process transactions in a myriad of ways. Bitcoin uses something called proof of work, where they have these big computers, miners that are rigged up in warehouses, and they try to solve what essentially is an arbitrary mathematical puzzle for the right to add transactions to a blockchain. Staking is seen as more energy efficient, and in that case, as opposed to using computer power, essentially token holders post their assets as collateral for the right to add transactions to the network, get rewards, and that's usually done in a manner that's commensurate with the amount of assets that you post. One big issue with staking, however, is that there's something called a bonding and unbonding period, and it differs for asset to asset. Sometimes it could be a matter of hours, sometimes it could be days or weeks, where it takes some time for your asset to actually get posted, to actually get staked, so that you can start earning those rewards, and then sometimes it takes just as much time to get those assets back if you want to trade them, sell them, whatever. Liquid staking was designed as a way to sort of get beyond those limitations by creating a liquid derivative product where, say I want to stake Ether, I can provide my Ether to a protocol, perhaps like Lido, where they stake my Ether for me. I get those rewards, and I get a wrapped token, a replica of Ether that called staked Ether, which is then liquid, and I can kind of use however I want. With Ethereum getting very close next month, is going to have a critical upgrade where now the billions of Ether that has been locked in the platform since staking began almost over 2 years ago, all that's now going to be liquid. There's a real growing demand for liquid staking in the marketplace, and we're seeing tokens like LDO surge on the back of that.
Right, and back to your point before with layer 2 networks.
Mm-hmm. Yeah, so layer 2 networks, this addresses a critical vulnerability with blockchains, which is, for as great as they are, as complex, as sophisticated, robust, secure, they are not very fast. I mean, Bitcoin can only handle a couple dozen transactions a second. Ethereum is not much better. When Ethereum switched to proof of stake last year in September, it's laying the groundwork for a few more upgrades in the coming months and years that will eventually increase its throughput speed. But for now, we're left with something called, if somebody wants to use Ethereum, for a myriad of reasons, we're left with something called a layer two, which essentially is kind of a blockchain layer or platform that sits above Ethereum, is compatible with it, utilizes the underlying blockchain for security, but it tends to be faster, have cheaper transactions. And one of the big platforms that has been growing is Optimism, actually two, Optimism and Arbitrum. Both of those are actually growing and catching up to Ethereum in terms of transactions, which is kind of an underreported story. And they really got a lot of attention last week when Coinbase announced that it was building its own layer two platform on top of Ethereum using Optimism's tech stack. So scalability is a major theme for blockchains in 2023 as builders kind of focus on building and in the midst of this crypto winter and being able to have the throughput to handle what they hope to be thousands and millions of daily transactions. And layer two technologies seem to be a real focus point for that.
All right, so Stephen, let's move forward and talk about infrastructure and regulations for a moment
Sure.
here. How should the industry read the SEC's recent enforcement activities?
Yeah, so the SEC has certainly been on a mission these days. I mean, too many to count, where they're launching enforcement actions against stable coins like Binance USD. They sued Kraken and forced them to shut down their Ethereum staking service, claiming that they were unregistered securities. They sued Terraform Labs, which was and its CEO Do Kwon, which kind of the brainchild behind the Terra USD Luna collapse last spring, which wiped out about $55 billion in market value when it's really kind of the first of many dominoes to fall last year. And I think this really speaks to, I mean, two things. One, the SEC and honestly other regulators kind of see this as open season on less reputable projects out there. And while we're still in this sort of ambiguous period where the White House wants to do something in crypto, Congress wants to do something in crypto, the SEC and the CFTC are kind of frenemies, for lack of a better term. Plus, you're dealing with state regulators like the New York Department of Financial Services. Everybody wants to do something. Nobody wants to be accused of being asleep at the wheel. And Gary Gensler, the SEC chairman, has been very public about saying that basically he sees every single digital asset that is not Bitcoin as a security. So now I think we're seeing some of the fruits of all the work that the SEC has been doing, and they really see this as a time to step in and try to take out what they see as bad actors, so that if crypto does have the opportunity to move forward, which I do expect it to have, it's going to be a safer environment for investors.
Right, and this is exactly why the industry needs a regulatory framework, because how are they supposed to know what is labeled as security or not if that framework isn't in place? So
Right.
Let's talk about stablecoins for a minute here. What is the future of them, given the recent news concerning BUSD?
Yeah, so I think that the future is still similar to where it was before, but it is, I guess it is a bit murkier. So BUSD is a stable coin. It was called Binance USD. It was actually issued by Paxos, which is a New York trust company registered in New York, regulated by the New York Department of Financial Services. And they were ordered by the New York Department of Financial Services, and I believe it was on February 13th, to shut down BUSD, which at its peak was a $22 billion stablecoin, the third biggest in the industry, only behind Tether, the market leader, and USDC or USD coin run by Circle. And the reasons for the DFS doing that were basically that they felt that Paxos was not doing enough to, I guess, it was a little bit ambiguous, but having enough checks to make sure that there was enough collateral and that the asset was being used in a responsible manner. What kind of went unsaid with all this is that obviously the sponsor of this token was Binance, which is the world's largest cryptocurrency exchange. A lot of questions are out there right now about its financial dealings, its solvency, and just its operating procedures and responsibility. And I have a feeling that also has something to do with it, because Binance BUSD was only issued on Ethereum, but Binance itself runs its own blockchain called Binance Smart Chain. There's dozens of other blockchains out there, and Binance itself was creating synthetic versions of BUSD, which had fluctuating levels of collateral, and that also led to a lot of investor angst. So all of that together, I believe, caused the DFS to act against it. Now, the bigger question about stablecoins. BUSD is going to go away. The beneficiaries we're seeing so far are Tether, which is the market leader and has been facing its own questions. I wrote a big report on it last year about the quality and amount of its collateral and reserves. And I think this also just leads to the bigger question of when are we going to see central bank digital currencies like the digital dollar and its equivalents around the world? Because some people see that as the solution to all these synthetic dollars, to having an official backed cryptocurrency that is more trustworthy.
Right. Well, we'll lend more trust to the industry, right? Like, where are these valuations coming from, right? There are no earnings, there are no revenue. So it's kind of like, these valuations are, I mean, I guess, you're just assigning value to software at the end of the day. But Stephen, in the last minute here, you co-authored a report yesterday for Forbes Crypto about Binance's financial dealing, asserting that there are some similarities that you saw with FTX.
Yeah, so this is something that we had been working on for a while, and this kind of goes right back to the stablecoin question that we were talking about. We found reporting that on multiple occasions, Binance took out the collateral that it used to issue these Binance Peg tokens, and on one particular occasion, we found that they took out more than $1 billion of USDC, which underpinned a Binance Peg USDC token on these other blockchains, and passed it through to a number of prominent hedge funds like Cumberland, Alameda Research, Amber Group, and it's hard to know exactly what happened with the tokens after that. But regardless, it's very concerning, because for those tokens in particular, because of the EQ focus on stablecoins, it's very important that users that own these synthetic assets, these replicas, know that they can always redeem them one-to-one for the underlying asset. And if that's not true, then it could lead to questions about the overall nature of stablecoins in general, and that could certainly have a cataclysmic impact on a crypto ecosystem.
All right, Stephen, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great, thanks, Joe.